Fed just reignited inflation while saving the big banks. What do I mean by that? Well, the Federal Reserve Bank just cut interest rates by 0.5%. They committed to cutting interest rates by another 0.5% in 2024. They said they want to cut interest rates 4 times in 2025. And then they said they want to cut interest rates another 2 times in 2026. Now, the Federal Reserve Bank generally cuts interest rates as a way to spur spending and stimulate the economy. But if you look at all the economic data, it says that our economy is still one of the strongest economies in the history of time. So if we're in such a strong economy, why do we need to stimulate it? And if you cut interest rates, what does that do for inflation? Well, what we know historically, the lower interest rates generally contribute to more spending, and it also generally contributes to more inflation. Because if we think of it this way, if interest rates fall and mortgage rates fall, home prices generally go up. Why? Because if you can go out and get a 30-year fixed rate mortgage at 4% instead of 8%, it's cheaper for you. So you might want to go out and start bidding on homes again. And if you start to see more bidding wars, home prices start to go up, and then the CPI numbers start to go up. So we know the lower interest rates can contribute to more spending, which can create more inflation, especially if you're in a strong economy. But the Federal Reserve Bank is thinking a little bit deeper here, because there's been a lot of pressure from the big banks and big corporations for the Federal Reserve Bank to cut interest rates. Why? Because all these banks and corporations are sitting on all this debt that is now starting to come due. In 2020 and 2021, we saw pretty much every big corporation and every big commercial landlord go out and either take on debt or refinance their debts when interest rates were at their lowest levels ever, which was a great thing to do. The problem is that those debts for commercial landlords and for corporations are not 30-year fixed rate mortgages. They're readjusting debts. And so now we have the first wave of debts starting to readjust in 2024, and we have a larger wave of debts starting to readjust in 2025. This had the big banks worried, because if a commercial landlord who's sitting on a half-vacant office building sees their debt payments go up, they're not going to be able to make the payments. And instead of mailing in a check for the mortgage, they might just mail in the keys. And the same with the corporations. If people can't afford to spend, then maybe they're going to have to downsize, and maybe they won't be able to pay back their debts, which is bad for the corporation and that's bad for the bank. And so now the Federal Reserve Bank is committed to cutting interest rates, which sounds like a good thing, but it comes with a consequence. What is the consequence? Well, the consequence is, of course, inflation, a silent tax. Now, the reason why you want to pay attention to this is because inflation is one of those things that's been around, and the Federal Reserve Bank likes it when the average person doesn't know that inflation is happening. Over the last 5 years, we've really seen inflation ramp up. And I started after the 2020 pandemic, but between 2020 to 2024, we really started to see this inflation problem, and the average person became more aware of what inflation is. And the reason why they did is because inflation significantly outpaced wages. But that's not a new phenomenon. It just became very apparent during the pandemic. Let me give you some numbers. Between 2019 and 2024, the median income went up by 14% in America. Reported inflation between 2019 and 2024 is 23%. That's reported inflation, not the real inflation. Real inflation means the things that you buy. If you're buying groceries, well, that could be a different inflation than somebody else. But the reported inflation is 23%, and many people saw an inflation number that's actually higher than that, but we'll stick with the reported numbers. Median household income went up by 14%, median inflation 23%. What does that mean for the average person? Your wages went up, you got a bigger paycheck, which feels good, but for the average person, inflation outpaced how much money you made. So yeah, you're making more money, but more money is going towards your rent payments, your grocery payments, your car payments, and everything in between, which means you have less money today to save and invest, even though you're making a bigger paycheck. That's what inflation does. And the problem is that when you have low inflation, the average person doesn't notice it happening. I mean, we've been seeing inflation for decades now. It's just that the average person hasn't noticed it when it wasn't that hot. Now, the Federal Reserve Bank says that they want to see 2% inflation. But you have to wonder, why 2%? Why not 1%? Why not 0.5%? Actually, why not 0% inflation? Or why not negative 2% inflation to correct for all the inflation that we've seen over the last couple of years? And the reason why is because this inflation is good for the Fed, it's good for the government. Why? Because inflation means that the United States government can pay back the $35 trillion of national debt with cheaper dollars. So they're inflating away the value of this national debt, because if you don't have that inflation, well, that $35 trillion then becomes more expensive. Not to mention that the United States government can't keep affording making their debt payments. We covered this in Market Briefs, which is my free financial newsletter. If you have not joined Market Briefs yet, it's a free newsletter where every day my team is breaking down what's happening in the economy, the housing market, the stock market, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. You can read it in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, I got the link for you down in the description below. But the national interest payments for the government are higher than our military expenses. Why? Because not only is the government borrowing more dollars, but the interest rates are so much higher. And so you got to imagine that there must be some political pressure on the Federal Reserve Bank saying, hey, can you make our debt payments a little bit cheaper? Because most of this debt has to be paid back to the Federal Reserve Bank. And so if the United States government can tell the Fed, hey, lower interest rates, there might be some pressure there. Now, the Federal Reserve Bank, although they're called the Federal Reserve Bank, they're not federal. It says so on their website. They're not a reserve because they're not sitting on any cash reserves. And they're not a bank because you and I can't go there to deposit money. And Jerome Powell, who's the chairman of the Federal Reserve Bank, has said time and time again, because he's been grilled on this, that they're not swayed by any political parties, that they are not influenced by the government. They're not influenced by Democrats. They're not influenced by Republicans. They're not influenced by independents, that they themselves are independent and they make their own decisions. But you have to imagine that there is pressure because, well, the people that elect, the people that work at the Federal Reserve Bank are, of course, working at the government. So these are the things that you want to think about, not to mention the fact that, well, lower interest rates could make the inflation problem worse, which is good for certain people, but bad for other people. What do I mean by that? Inflation hurts some people more than others. Now, we saw this in full effect over the last 5 years, because if you don't understand how inflation works, chances are you're the person that's paying the price, versus the financially educated and the investors get to benefit from inflation. What do I mean by that? Well, let's go through the numbers. Between 2019 to 2024, reported inflation, 23%. Median household income, 14%. Home prices grew by around 50%. The S&P 500, the stock market, grew by around 80%. So, inflation means more dollars flow into the hands of assets, into the hands of investors, because investors are the ones that owning assets, which is great if you are an investor, great if you're financially educated, great if you understand inflation, not so good if you don't understand inflation. That's why this is so important to understand, because most people assume lower interest rates are good because I get a lower interest rate on my mortgage, I get a lower interest rate on my car loan. But the problem with that is lower interest rates can also contribute to more stupid spending. And this is not just for consumers, it's also for businesses. Let me explain the consumer side, then I'll explain the business side. For consumers, if you can borrow money for cheaper, it's easier to entice somebody to buy a brand new Escalade that you can't afford. We saw that happen in 2020 and 2021. We saw a lot of people buying a lot of fancy cars just because the interest rate was cheaper. Who cares about the car price? I'm just looking at the car payment. It's a very bad way to look at things. It's not a very financially educated way of looking at things, but it's a dream for car salespeople. But it's also the same for businesses. You might have heard the term zombie companies. Zombie companies is something that became very popular when interest rates started to go up. A zombie company is a company that doesn't make money, but they continue to operate because investors keep feeding them money, and they're hoping that this company will eventually make money. Now, there's a lot of companies that don't make a profit, but they eventually do make a profit. Like Uber is a famous example of this, that didn't make a profit for many, many years. But there's a difference between a company that has a path towards profitability and a company that does not. Because when you have low interest rates, you have a lot of investors, institutional investors, that will borrow a lot of money for cheap because it's essentially free when interest rates are very low. We're not there yet, but you have to wonder how low interest rates will go. That's why I'm bringing this up. When interest rates are cheap, institutions start to borrow more money because it's cheaper to borrow money. And then they want to take this money and put it somewhere. And when you can borrow money cheaper, you can make riskier bets. And when you can make riskier bets, you can also make stupider bets, which means you start to see the growth of more zombie companies, more companies that don't make any money and don't have a path towards profitability, because these are companies that are spending $1 to make 50 cents. And that's okay when there's free money floating around or easy access to money floating around. And that's the concern, because that can't last forever. And just like in 2022, when interest rates started to go up, a lot of these zombie companies went bankrupt. We saw a huge surge in layoffs. It was a tough time for anybody that was working in those companies. And the people that were working there, they didn't do anything wrong. They applied for a job, they got a good salary, they took the job, they worked hard, and then found out that the company wasn't actually a good company, and then they lost their job, and then they had to scramble to find a new job. And so when you have these lower interest rates, the first thing that happens is it can encourage dumb decisions. B, it doesn't encourage saving money, because when you have lower interest rates, well, your savings account is not going to pay you as much, which isn't good. Not to mention that inflation can also go up, which means your savings are being eaten away by inflation, which doesn't encourage saving. It encourages people to put their money to work. And if you don't have any financial education and you don't understand how to invest your money, then your money just sits there and the average person becomes poorer, because now you save your money, which isn't growing, because now savings accounts pay less and less interest. While people don't know how to invest their money, asset prices go up. So now the average person can't buy as much from their savings, while many times incomes don't even keep up with inflation. That's why lower interest rates, while they sound good in the beginning, are actually bad for the average person who is not an investor. Now, don't get me wrong, there's a benefit with lower interest rates. For the people that are financially educated, for the investor, lower interest rates are great, because that means you can take advantage of lower interest rates. You can take advantage of what happens to asset prices. For the financially educated, it's good, but for the average person, it is not always as good. But I also want to point out this, because a lot of people are saying that every time you see lower interest rates, markets go up, and that is a lie. That's not true. So let me actually go over some of the previous rate cut cycles and what they did to the S&P 500. In 2020, we had 2 emergency rate cuts when the pandemic happened. The Fed cut interest rates by 1.5%, and the stock market rose by 16% over the year. In 2019, the Fed cut interest rates by 0.75%, and we saw the stock market, the S&P 500, rise by just over 28%. If you remember back in 2019, the Fed was worried about a potential slowdown in the economy, so they started preemptively cutting interest rates in 2019 when, well, we saw the stock market rise almost by 30% in 2019. But let's go back a little bit more. 2008, the Fed cut interest rates by 4.25%. The stock market fell by 38.5%. In 2007, the Fed began getting worried about the economy, and they cut interest rates by 1%. The stock market broke a brand new record high in 2007, and the stock market rose by 3.5% in that year. 2003, the Fed cut interest rates by 0.75%. The S&P 500 rose by 26%. And in 2001, the Fed cut rates by 4.75%. The S&P 500 fell by 9.1%. So what does that mean? Sometimes markets go up when the Fed cuts rates. Sometimes markets go down when the Fed cuts rates. Don't try to time the market, but rather understand how rate cuts affect the economy, because the stock market and the economy don't always move linearly. But over the long term, we start to see a lot more correlation between the stock market and the economy when you look at a longer period of time. We know the lower interest rates are there as a way to stimulate spending. We know the lower interest rates are a way for people to go out and take on more debt, businesses take on more debt, and to refinance. All those things encourage spending, but there's a consequence. That consequence is, of course, the risk of inflation. I'm not going to say guaranteed, because nobody knows what's going to happen tomorrow. I'm just a random guy on YouTube. I'm not a financial advisor. You got to make your own decisions. Don't blindly trust a random guy on YouTube. You know the whole disclaimer. But this is where you, as a financially educated person, want to pay attention and make smart financial decisions. Again, I'm not a trader. I don't advocate trading, because I have no idea what's going to happen tomorrow. I have no idea what the market is going to do tomorrow. I have no idea what the Fed is going to say tomorrow. I have no idea what's going to happen. Instead, I want you to be a long-term investor and understand what's happening in the markets. And that means, number one, be financially prepared. Have money to invest in case you see an opportunity. 2, be financially educated. That means if you're investing in stocks, learn how to read financial statements. If you're investing in real estate, know how to underwrite a deal. If you're investing in ETFs and index funds and mutual funds, understand what an expense ratio is. And then number 3, understand financial trends. That means pay attention to where money is moving in the economy. Pay attention to what shifts are happening in the economy. We cover that in Market Briefs Pro as a paid newsletter that we have. But this is where you want to pay attention to the different things that are happening in the economy. That way you can take advantage of opportunities that come your way. And instead of trying to time the market, understand the economy. That way you can build wealth as things change, because we are entering a new phase in the economy now with the Federal Reserve Bank committed to cutting interest rates. We'll be keeping you updated here on YouTube, and we'll also be keeping you updated on Market Briefs. So if you have not joined yet, I got the link for you down in the description.